Hey, hurry up, let me ask you something. Jordan thought he'd solved the problem when he moved his money into a high-yield savings account, paying 4.5%. But actually he was very wrong. He did research everywhere. He knew traditional savings accounts were a ripoff. While everyone else was earning 0.45%, Jordan was earning 10 times that. He thought he'd solved the problem. He didn't. He couldn't. His bank was earning many, many times more from his deposit. And the thing his high-yield account was doing with his money, Jordan could have done it himself and kept the entire yield. But here's the part that really stings. His coworker, Maya, still had $20,000 sitting in a traditional savings account. In 1 year, her bank paid her $76 in interest. That same year, her bank used that $20,000 and earned over $200. Maya got $76. The bank got the rest, and Maya thanked her bank for it. Maya had no idea she was losing money. Jordan thought he'd solved the problem. They were both wrong. Banks actually hide everything from us, and when they make up a little lie for us, we believe it right away. They earn more than everyone. And they give us money like they're giving alms to a beggar. Let's solve the bank's secret together, by the way. Let's not forget to subscribe to the channel. Let me guide your life. I'm Mia. Let's get started. Maya did Everett Ingrid Mret Maya did everything she was told to do. She saved 6 months of expenses. She kept it in a savings account at a big national bank. She checked her balance every month and saw a small interest deposit. It wasn't much. A few dollars here, a few dollars there. But it felt responsible. It felt safe. Her savings account was paying 38% annual interest. That's the current national average according to FDIC data. On $20,000, that's $76 a year, about $6.33 a month, not even enough for lunch. Now, Maya probably never thought about what her bank was doing with that $20,000. She probably assumed it was just sitting in a vault somewhere waiting for her. The moment Maya deposited that money, the bank put it to work. Not for Maya. For themselves. What your bank actually does with your money. Here's what Maya's bank did with her $20,000. The first thing they did was lend it out. This is the core business model of every bank in America. They take your deposit, pay you a tiny fraction of a percent, and lend that money to someone else at a much higher rate. The difference between what they pay you and what they earn is called the net interest margin. And right now, the average net interest margin for U.S. banks is 3.39%. That's the highest it's been since 2019. Let's put that in real numbers. Maya's bank paid her 0.38%. They earned an average of 3.39% on the money they lent out using her deposit. On $20,000, that's a difference of about $602 a year that the bank keeps for itself. Maya got $76. The bank got $602 from the same $20,000. But that's just the average. Let's look at where the really wide margins are. Credit cards. The average credit card interest rate in the first quarter of 2026 is 21%. Maya's bank takes deposits like hers, pays her 0.38%, and lends that money to credit card holders at 21%. That's a spread of more than 20 percentage points. On $20,000, if the bank allocated even a portion of Maya's deposit toward credit card lending, the profit from that slice alone dwarfs what they paid her for the entire year. Auto loans. Right now, the average rate on a new car loan is around 7.5%. Mortgages, around 6.8%. Personal loans, around 12%. Every one of these lending products is funded in part by deposits like Maya's, and every one of them earns the bank multiples of what Maya receives. Then there's the Treasury trade. And this is the part that should really stop you in your tracks. These Treasury trade, Maya's bank takes a portion of her deposit and buys short-term U.S. Treasury bills. Right now, 3-month Treasury bills are yielding around 3.6%. The bank buys those Treasury bills with Maya's money, earns 3.6%, and pays Maya 0.38%. That's a 3.22% spread on an asset that Maya could buy herself. The bank is literally acting as a middleman between Maya and the U.S. government, and charging her over 3% for that privilege. The fees nobody talks about. Now sit down, because this part is really going to annoy you. American banks collected an estimated $12.1 billion in overdraft fees, NSF fees, ATM fees, maintenance fees, and other service fees in a single year. JP Morgan Chase alone collected over $1 billion in overdraft fees in 2024. Wells Fargo, almost the same amount. These fees are charged to the same customers whose deposits fund the bank's lending operations. Maya's $20,000 is part of that machine. Not to mention the interchange revenue the bank earns from the merchant every time Maya swipes her debit card. Not to mention the float, income the bank earns on pending transactions, holding your money for a day or two before it actually clears. Not to mention the anonymized data on your spending habits that banks package up and share with marketing partners. Every one of these is another profit channel built on top of Maya's deposit. Add it all up, and the picture becomes clear. Maya's bank didn't hold her money. They rented it. They paid Maya $76 a year for the right to use her $20,000 however they wanted, and she thought she was earning interest. Now let's talk about Jordan, because Jordan is the person watching this video saying, I already knew that. That's why I moved my money to a high-yield savings account. And Jordan isn't wrong. He's way ahead of Maya. The high-yield savings account pays 4.5%, while Maya's pays 0.38%. On $20,000, Jordan earns about $900 a year, compared to Maya's $76. He did his homework. He made the switch. He's earning 10 times what the average saver earns. So what's the problem? The 3 problems with Jordan's smart move. Look at this. Because the first problem is that 4.5% might not be what Jordan is actually earning. Many high-yield savings accounts advertise up to a certain rate. That word, up to, is carrying a lot of weight. Some accounts use tiered rate structures, where the top rate only applies to the first 500 or 1,000. After that, the rate drops. Some offer a promotional rate for the first 90 days, then quietly lower it. Jordan saw 4.5% in the headline. His actual rate might be lower. The second problem is tax treatment. Interest earned on a savings account, whether traditional or high yield, is taxed as ordinary income. That means federal tax plus state and local income tax. If Jordan is in the 22% federal bracket and lives in a state with 5% income tax, he's losing more than a quarter of his interest to taxes. His $900 drops to roughly $657 after tax. The third problem, and this is the big one, is what Jordan's high-yield savings account is actually doing with his money. Where do you think the bank finds the return to pay Jordan 4.5%? They're doing exactly what we just described with Maya's bank. They're lending it out. They're buying Treasury bills. They're running the same profit machine. The only difference is that a high-yield account shares a bigger slice of the profit with the depositor, but it's still a slice. The bank is still the middleman, and the middleman is still taking its cut. And here's the question Jordan never asked. If the bank is using my money to buy Treasury bills and earn 3.6%, why don't I just buy those Treasury bills myself? I ran the numbers. 3 scenarios, same 20,000. Same 12-month period. 3 different scenarios. Scenario 1, Maya's traditional savings account, 0.38% annual. Gross interest earned, 76. After federal and state tax, she keeps roughly 55. That's what 6 months of responsible saving earns her in a full year. Scenario 2, Jordan's high-yield savings account, 4.5% annual. Gross interest earned 900. After a combined 27% federal and state income tax, he keeps about $657. A huge improvement over Maya. But here's the thing, he's paying tax on every dollar of that interest at both the federal and state level. Scenario 3, a short-term Treasury bill ETF like SCOV. As of April 2026, SCOV's 12-month trailing yield is 3.95%, with a 30-day SEC yield of 3.55%. On 20,000, it's approximately $790 in gross income over a year at the trailing yield, or about $710 at the current 30-day rate. And here's the interesting part. Interest from U.S. Treasury securities is exempt from state and local income tax. That's federal law. So Jordan pays both federal and state tax on his $900. The SCOV investor pays only federal tax on their $790. After tax, the SGOV investor keeps roughly 60-16 at the trailing yield, and they do it without paying any state or local tax at all. But let's be fair. Ayaz Jordan really behend? Now you might look at this and say, wait, Jordan's high-yield account is still slightly ahead in raw dollars. And in this specific comparison, yes, 4.5% is higher than 3.95%. But here's what that comparison misses. Jordan's 4.5% is an advertised rate that can change at any time without notice. The bank can drop it to 3.5% next month and send him an email about it. SGOV's yield tracks actual Treasury bill rate set at U.S. government auctions. Transparent. Market-driven. No surprise rate cuts. Jordan's 4.5% is subject to state income tax. SGOV's yield is not. In a high-tax state like California or New York, that exemption alone can close the gap. And Jordan's 4.5% still means the bank is acting as a middleman. SGOV cuts the bank out entirely. You're lending directly to the U.S. government through Treasury bills and keeping the entire yield except for 0.09% annual fee. The point isn't that one option is always better than the other in every scenario. The point is that Jordan never knew he had this option. He thought the high-yield savings account was the finish line. It's not. It's just a better seat in the same machine. So what should you actually do? Simpler than most people think. First, keep your checking account. Don't close it. You still need it for daily spending, rent, bills, everything that regularly comes in and out. This isn't about how you spend your money. It's about where your idle money sits. Second, identify your idle cash. This is your emergency fund, your savings, cash waiting to be invested, money you're setting aside for a down payment or a big purchase. This is the money sitting in a savings account earning next to nothing while your bank earns 10 to 50 times more on it. Third, here are your options for moving that money. Option 1, a Treasury bill ETF like SGOV. You buy it through any brokerage account, Robinhood, Schwab, Fidelity, Webull, whatever you already use. You buy it like a stock. The ETF takes your money and invests it in U.S. Treasury bills, maturing in 3 months or less. You get paid a dividend every month. That's the interest income. Right now, depending on which measure you look at, it's yielding around 3.55% to 3.5%. When you want your money back, you sell it during market hours. The price always stays around 100. It's designed that way. The expense ratio is 0.09% a year. On 20,000, that's 18 a year. And your distributions are exempt from state and local income tax. Option 2, treasurydirect.gov. This is the U.S. government's own website where you can buy Treasury bills directly. No middleman at all. No brokerage, no ETF, no expense ratio. You set up an account, link your bank, and buy Treasury bills at auction. When they mature, you get your money back with interest. The downside is that it's less liquid than an ETF. You're committing to a maturity of 4 weeks to 52 weeks. But if you don't need instant access, this is the purest way to cut out the middleman. Option 3, a money market fund. Offered by brokerages like Fidelity, Schwab, and Vanguard. They invest in short-term government securities and other high-quality short-term debt. They offer daily liquidity. You can pull your money out anytime. Yields are currently competitive with high-yield savings accounts, and if you choose a Treasury-only money market fund, you get the same state tax exemption. 2 objections. And they're real? Answer. The most common objection I hear is, but my savings account has FDIC insurance. And that's true. FDIC insurance covers up to $250,000 per depositor per bank. If the bank fails, the government guarantees your money. That's a real protection. But think about what you're comparing it to. Treasury bills are debt issued by the same U.S. federal government that backs the FDIC. When you buy a Treasury bill, you're lending money directly to the government. The risk of default is essentially zero because the government has the power to print money to pay its debts. You're not giving up safety when you move from a savings account to Treasury bills. You're moving from a government guarantee on your bank to lending directly to that same government. In some ways, it's more direct. Second objection. I need instant access to my money. Fair. And that's why you keep your checking account funded for daily needs. For your emergency fund in something like SGAV. Yes, there's a 1 to 2 day settlement period when you sell. But be honest, when's the last time you needed 20,000 in cash within 60 seconds? In a real emergency, 1 to 2 business days is usually fine. And the yield difference while you wait for that emergency to happen is worth hundreds of dollars a year. The real lesson: Maya was responsible. She saved her money. She kept it in a bank. She checked her balance. She did everything right by the rules she was taught. Jordan was informed. He switched to a high-yield savings account. He earned 10 times what Maya earned. He thought he'd cracked the code. But neither of them ever asked the real question. What is my bank doing with my money, and can I do it myself? The answer is yes. Your bank takes your deposit, buys Treasury bills, lends it out at 7% to 21%, and pays you a fraction of a percent. The smartest move isn't finding a better savings account. It's asking why you need one at all. CTA closing: if this video showed you something you didn't know about what's really happening with your money, hit the like button. Subscribe to Mia Reveals and turn on the notification bell. Every week I break down the hidden math behind the financial decisions you face. And drop a comment below. Are you a Maya, a Jordan, or already ahead of both? I read every comment. See you in the next video, and it's one you won't want to miss.